The high degree of leverage, one of the culprits of the credit crisis, regulators, economists, banking chiefs, all jousting over the issue of how much equity banks should hold. Latest meeting of regulators in September, Basel III included a proposal. Final decision on capital requirements supposed to be reached by December of this year. Stanford Business School professor Anat Admati is with us now with her view of what should be done. Professor, so glad you could come to New York. We know you're usually based in California. Nice to have you here. So you say banks should hold higher than the 7% that the Basel III proposal had, and you say this 2019 time frame is honestly just too far away. But I want to ask you about one of the arguments out there that raising the capital requirements is actually going to hurt banks' ability to function. Why is that not true in your view?
Well, first of all, I want to correct one thing that you said, which is people use the word hold in the context of capital, and it's not holding anything. They say set aside, they say hold in reserve, and you don't say that about Apple or another company that's funded with equity. What we're talking about is not holding it in any particular way, but actually just funding what they do with equity more than with debt. So just like a lot of other companies do that, and most companies in the economies have a lot of equity or mostly funded with equity. The question is, debt versus equity, how should they be funded? Are we stuck with having huge leverage for banks or not? And the argument I have is that there's no real reason that they cannot be funded with a lot more equity instead of with debt, so that they don't have the only 5% equity, because we know that's extremely unstable and fragile, just like a homeowner buying.
So you're saying equity capital represents the share of the firm's total value held by shareholders. It's not so much about just cash that is put aside that cannot be invested.
That's liquidity requirements. Liquidity requirements are on the asset side of the balance sheet, and they tell them what kind of securities to hold, how much cash to hold. Capital requirements are not about that side of the balance sheet at all. They are about the fraction of operations, assets that are funded with particular securities, with an IOU security or with stocks kind of thing. Now that most of the banks are publicly held, so it's just a question of how much equity versus how much, long-term, short-term, all kinds of debt they have. And what we're saying is that they can have a lot more equity and we'll all be better off, and they won't necessarily be worse off. And we can explain why they like the leverage so much, but it's kind of paradoxical why.
Anat, it's Erik Schatzker here in London. I want to jump in and ask you a quick question about where the equity is going to come from. Let's say we buy your argument that more equity is good and that it is not expensive in a financial sense and perhaps could do some social good. Who's going to provide the banks with all this equity? Because some banks have had not that easy a time raising equity coming out of the financial crisis.
Well, first of all, it depends on the price, and if prices have to go down, we have to ask ourselves why that is. But equity is purchased by institutional investors, pension funds, everybody who buys, large, wide, diversified portfolio of stocks like we tell them to in most standard business school courses. So there's nothing magical about this equity. It's part of portfolios, and it's going to continue to come from wherever equity comes from the end investors in the market. And it just has to be valued correctly, which we believe it usually is, in ahead of understanding its risk and how it fits in a portfolio and all of that. So there's nothing mysterious about where this equity is going to come from. It just has to be at the appropriate price.
Professor, thank you so much for coming in. Like seeing you here on the East Coast. Anat Admati, she is a professor at Stanford Business School.